we're going to be talking about money and how to bring money into your company. Uh, Again, if there are any questions, just pop your hand up. I'll get to it. Small crowd, I like making it more discussion oriented. I'm going to be going through a decent amount of content. I'll be throwing in references that you can follow and read up on later. Uh, this can easily be like a whole day seminar. I've just condensed it to about 30 to 45 minutes. And then depending on questions, it might go on for longer. But that's all the context I really need to give you, just to get a sense of the crowd who's currently raising money or planning on raising money in the next 6 months or so. I'm gonna pop through some content. So there's fundamentally three ways of getting money, especially at the early stage: investors, grants, and sales revenue. And when you are a founder, you obviously have limited time. You can't go chase each of these paths down. And you kind of have to figure out which ones you focus on. And there's no golden answer, unfortunately. You constantly have to be reassessing what the right thing is for you. The one thing I like to tell my teams is double down. If you are planning on raising money, then sort of double down on it. It's really hard to sort of jump between modes unless you're okay with a really long, extended fundraising sort of process. I'll tell you through my journey, what I went through as the conversation progresses. I've been part of 2 fundraising rounds, and now I'm on the flip side. I do some angel investments, and I work with a decent number of VCs. So I'll share sort of stories and opinions from both ends of the table. So yeah, how do you know what to focus on? Ultimately, as I mentioned, it depends. And the trade-offs you'll be asking yourself is, can I get sales revenue to a point where I can sustain myself and my business versus go raise capital? And sometimes that's right. So sometimes that will make sense. Other times it will not, especially if you're a deep tech company. You are more often than not looking to raise private capital. You can potentially get away with public capital because there's a lot of money out there in the public markets. Public meaning government grants, pitch competitions, and things like that. But it's hard to go beyond sort of the $500,000 mark. We're using just sort of government programs. The fundamental thing that will be a theme you're going to see throughout the next 40 minutes or so is building credibility and trust. And a lot of people use them interchangeably. Let me be very explicit in how I define them. Credibility is about what you've done in the past. So credibility comes from, having experience in the industry that you're in, having done research in the industry or the industry of your startup. But it's looking back in the past. Trust is about promises that you make in the future. Can I trust you to do X? Will you hit X milestones based on the money I give you? And investors will constantly be jumping between, does the person in front of me have credibility and the person in front of me have trust? And you'll come to realize, as whether you're raising money from investors, granting agencies, anyone who you're selling to will be asking these fundamental questions. What have they done in the past, and can they deliver in the future? So before we jump into any specifics, for those of you that don't know, I'll just talk about broadly a startup's financial journey. And it's namely broken up into the following slots. By the way, these are just names. It applies to about 80% of the industry, and they follow a lot of this nomenclature, but a lot of it changes. A lot of it is focused on marketing, but I'm going to distill a lot of that context down. So what I call pre-seed is anything between $0 and $1 million. This is typically money that you'll get from incubators, accelerators, grants, pitch competitions, or convincing your friends, family to put some money in to help you accomplish your dreams. The seed round or the seed stage is typically where angel investors and VCs will come in. Typically, seed rounds are $1 to $10 million, but they've grown in size. I've seen seed rounds that have done $15 million. I've seen seed rounds that are a few $100,000. Every year, it seems to, every about 3 years, the average seed round doubles, which is fascinating. It used to be a few $100,000 was the seed round. Now seed rounds are easily in the millions. Most seed rounds I see these days are at least $1 million. Then you get into Series A, which is in the ballpark of $5 to $50 million. And here, not only are you working with VCs, but private equity firms and family offices will also want to take part. Family offices, for those of you that don't know, are typically a wealthy estate or family wealth that has been generated, and a lot of them will now invest directly in technology companies. Whereas before, a lot of family offices will do just traditional sort of stock market investments. They'll go into hedge funds. They'll go into funds of funds. A lot of family offices are now funding direct companies themselves as well. And then similar case for Series B and Series C. They're all usually 10 million or plus. Can go up to hundreds of millions of dollars. And then eventually you'll take your company IPO, and this is where you get traded on what's called the public markets. So get listed on the stock exchange. Now, I want to point out some trends that have been happening to this ecosystem in the last year or two. First, there's been a huge capital push for fewer companies to go IPO. Because when you want to go IPO, you typically want a large exit event. And what a lot of, let's call them industrial entrepreneurs, are realizing is before you go IPO, you can raise a bunch of extra money from private sources and give a good profit to those investors with the promise of IPO about 6 to 12 months down the road. So the Series C area, where you invest about in the ballpark of $50 to $100 million, has been growing exponentially. If you want to look at this in more detail, look at Tiger Capital, look at Silicon Valley Bank. They're writing checks in the hundreds of millions, definitely tens of millions, but in the $100 million range as well. Pension funds are getting into this space as well, as a way of making profit before a company IPOs. Now, this influx of late stage capital has shifted people who traditionally invested in Series B and Series C. They're getting very competitive for deals. And as a result of this competition, a lot of their later stage investors, so these are people who have billion-dollar funds or funds in the hundreds of millions of dollars, have started writing earlier and earlier checks because that's where they will win out. So a lot of influx has sort of pushed momentum downstream, such that there's more and more people writing seed and Series A investments, and it's one of the most competitive times in technology investment. So something you should know: if you there's a lot of investors out there, and B, if you're planning on raising money, you don't have to attach yourself like, I must get this investor's money right now, as they might make it seem like on Shark Tank or Dragon's Den. If you watch any of those shows, you truly have a lot of options available to you just because of the influx of investors at the early stage. So let's talk about the early stage ecosystem. And this pertains to most people in this room. And when I say early, I should have put this in brackets. The early ecosystem is basically this pre-seed stuff that Daniel was just asking about. So who are the players and who you can go for money? So obviously there's a bunch of student grants. So student grants, government grants, You can ask your friends and family for investment. There's government and university incubators like iBoost, and will run programs like the ESH program. There's also private incubators out there. They exist more in the US than they do in Canada, but some do exist in Canada. And then obviously accelerators. These all sound like similar money pools, but their intentions and motivations are completely different. And it's important for you to know the difference because you'll know what type of pitch to make to them. So for student grants, all they care, for the most part, what they care about is learning goals. Have you learned something along the way via this tool of entrepreneurship? Government grants care about job creation for the most part, and sometimes they'll care about things like IP commercialized, companies created, so on. Family and friends, this is a touchy topic. Me personally, in all the companies I've built, I've never taken money from family or friends. I don't like mixing personal and professional life, but this really depends on your relationship with the people around you. Some people genuinely just want to support you through the act of, giving you money while taking a really high risk bet. Government and university incubators are typically free, like IBZ. We're mandated by the government, by the university to help our founders and startups. But essentially, it will come down to economic goals or learning goals. More often than not these days, it's focused on economic goals. Private incubators will want to take equity. So since Daniel's face, I can see there's a private incubator called Forest City Synbio that is approaching a lot of synthetic biology companies, and they'll take a small chunk of equity and give you a small bit of capital. So incubators will typically provide you with other stuff beyond just cash, like advisorship, networks, sometimes lab space if your team needs that. Accelerators, while incubators and accelerators are sometimes used interchangeably, I really want to dispel out the difference. Accelerators are typically shorter in duration. Incubators can last a year plus. Accelerators, on the other hand, are typically 3 to 4 month programs, sometimes even shorter, actually. And the way accelerators make money is by helping you get to a higher valuation. So they'll put in money. Let's say they put in $100,000 at a 5% for a 5% stake in your company. They essentially want to double that up or even higher and help you raise at a $10 million valuation. So they come in at a $2 million valuation. Even if they get a portion of their teams to the $10 million valuation, generally speaking, they're netting a bunch of money and at least book value of the companies that they've invested in. So that's their primary purpose. I highly recommend that you don't apply to accelerators for the sake of applying to accelerators, because once you apply and once you take equity from them, you're kind of on this countdown clock of raising money once the incubator ends. And everything that the accelerator does is kind of focused on that. Anywhere from demo day to the networks they have, to the advice that they'll give, it will all be focused on helping you raise money for the most part. Okay, then once you get outside of the pre-seed ecosystem, let's talk about broader investor ecosystem. So there's angel investors, VCs, family offices, sales incubators, and sort of investor networkers. I'll only talk, again, you can Google a lot of these things. I'm just going to talk about the ones that you most pertain to the folks in this crowd, which is angel investors, venture capitalists, and this new thing that's been popping up in the last 2 or 3 years called angel syndicates, primarily over AngelList. Crowdfunding platforms, we won't get into that much. They still haven't reached critical mass, but you can go raise your round on a crowdfunding platform as well. So angel investors, they, for the most part, want to help a younger version of themselves. These are people that have done well in their careers. Maybe they were a startup founder themselves and now giving that money back to a younger version of themselves. They want part of the action, which is to say, they will want to be involved and try being as helpful as possible, especially if they've been an operator to you. But some of them are very, very laid back and will basically check in on you like once a year, like, hey, how you doing? You keeping alive? Is my money doing well? Venture capitalists are different. This is their primary job. They have an interest in making money for their LPs. LPs are basically a venture capitalist investors. We'll get into this more later on, but their primary goal is to extract value from you. Some can be amazing. VCs help you in a bunch of ways, anywhere from hiring, getting you more capital, getting you loans, helping with customer discovery and sort of sales work. But they also come with this baggage that they'll almost always want some form of control. And based on sort of the control that they have, they might even push to get you to exit prematurely just so they can show money to their LPs. So something to be, again, I'll go through more details of how VCs work in a bit, but this should give you a good idea. The new thing that's popping up is what's called angel syndicates. They're kind of like a crossover between VCs and angel investors. There's typically one manager of a syndicate, and they basically take money from a bunch of smaller investors, and they invest that money as a fund. But you don't need all the bells and whistles that venture capitalists need. They're typically not as helpful. They're closer operationally to an angel investor, but their backbone is more like a VC. And this is becoming a more and more popular trend. Like I know people that have like raised money purely on marketing on Twitter and reaching out to people who manage angel list syndicates. So let's talk about raising money from investors, because presumably that's what everyone here wants to learn about. So an investor's motivations are different, as we've discussed. The one place that I didn't go into detail on is how VCs work, and that's what we're going to talk about. So you'll see this even with angel list syndicates or angel syndicates, but fundamentally, this is how an investment firm structure works. It's most commonly applied in the world of VCs or venture capitalists. So there will be multiple limited partners. This could be anywhere from hedge funds, what are called funds of funds. It could be family offices. And because they don't have direct access to companies like yourselves, they will end up investing in a VC, and they will end up marketing themselves and pushing them on to companies and giving these companies money. So the way this will work is this money funnels typically to what's called the investment partner, sometimes also called general partners. And when you're a small fund, you're not just a partner, but you also do the management, you also advise team, you also deal with operations, you also do due diligence. It's kind of like running your own startup in some sense. You're doing a bit of everything. But for the larger firms, the functions are broken up in the following ways. You then place together a management team, your own set of like chief financial officer or someone who manages day-to-day operations of the fund. And that management team will then put together advisors, sometimes also called EIRs or experts in residence or entrepreneurs in residence, to help advise the teams that they've invested in. Then you have associates, analysts, and principals. They typically help investment partners with due diligence, deal sourcing, finding teams like you to invest in. And then sometimes there's a separate due diligence team. And this is especially true for deep tech funds, because if you're investing in deep tech, one person very seldomly has a broad range of expertise. So you bring in, and these are typically researchers or ex-founders who've worked in sort of different verticals to help them assess what's a good opportunity to invest in. And then finally, sort of there's a day-to-day operations team that does, creates reports, manages the books, and any reporting that needs to be done for the LPs and for some regulatory bodies. The reason why I'm sharing this with you is when you're going to go out and raise, one of the questions you're going to have is, who do I speak to? Do I speak only to the investment partners because they're the ultimate decision makers? Do I go speak with an associate? Do I speak with an analyst? Do I speak with somebody from the due diligence team? You're going to be interacting with different people throughout the course of the investment decision-making process. It's important for you to know what the motivation and the role of each one is. A lot of people just go in blindly and think that all of these people are the same and they're all investors and I just need to convince all of them. But knowing the nuances of who's doing what will help you figure out what to tell them, what information to give them to get them on your side. The fundamental premise, like, yes, you can know all these things and it of course matters, but the fundamental premise of any successful fundraising, you build a great business and investors will come. I should put an asterisk here. Building a great business and also fundraising also has to do with storytelling. And especially if you're deep tech business and you're very early stage, you have relatively little credibility to go on. A lot of it is going to be a trust-based investment. They're trusting that you will accomplish particular goals in the future. And for that, storytelling becomes really, really important. So over the next few slides, I'm going to be covering the following parts. What you should have ready before you start your investment process in raising money, what the pitch is going to be like and how you should prepare for it, how you negotiate and push people when they're slowing down your decision making, and just other notes that I couldn't really fit anywhere else. So these are all the things you ought to have ready before you start raising money. First is legal documents. The second is due diligence materials. Due diligence material. So actually, let's start with legal documents. For an early stage team, this is relatively straightforward. This is typically your incorporation documents, any employment agreements that you have, and usually like a shareholders agreement or a bylaw agreement, depending on which law firm you work with. They'll say they come as slightly different in different words. But this type of stuff, your lawyer should be able to take care of. Or if you've incorporated through owner, they have like 80% of this. The next is due diligence materials. This is essentially, so when investors think of investing in your company, they're typically looking at 3 categories of risk. Market risk. Will someone buy what this team is building? Product/tech risk. Can this team build what they say they will build? And then execution risk. Can this team put together the resources necessary to go execute on the plan, on the business plan? And due diligence materials essentially craft the story or give them data that minimize these 3 categories of risk. And this is the hardest prep that you will have to do before you raise capital. Finally, if you have a demo or some demonstrable value that you've already built for, that would be nice to see. You should put together a list of investors that you want to target. And the way you do this is by looking at who has invested in this space before, who's invested in similar players. Go onto an investor website, look at their thesis. So you know what, I'll do a quick version of this right now. One of the investors I really like, this was one of my investors, is this fund called 50 Years Fund. So every investor will have Everyone can still see my screen, yes? Okay. So let's do sort of a guided demo of how I would do research. So like, okay, everyone will have something dramatic to say. We back the best entrepreneurs in the world. We back heroes, blah, 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 blah. And they will have an idea of portfolio. And you want to walk through their portfolio to see what type of investments that they've done. So if I am, again, I'll use Daniel because he's my first name on my screen. So if I'm Daniel and I'm working on a synthetic biology tool, it's like, okay, what similar companies have they backed? Okay, they've done Upside Food, presumably, and I would go do research on Upside Food. They're probably using biology to build these cultivated meats. Okay, they've invested in Opentrons. That Opentron sells to a lot of synthetic biology sort of companies. So they probably have a decent idea about synthetic biology. And as such, they'll be able to get what I am building. You also want to look at their team. So this is Seth and Ella, they're the founding partners, who their principals are, what they're trying to, and then what their backgrounds are. It's really, really important to understand what people do. So it's like, look up Seth. You go look at him on LinkedIn. So let's go. Okay, so and then another place to look is obviously Twitter. Click open. Okay, what has Seth done? Okay, it seems like he's into politics, he's into governance. He's been part of YC, so he'll be connected with the YC network. Has he studied any synthetic biology? Doesn't seem so. So he's probably not as technical. So he'll probably bring in somebody else for due diligence. And I'll kind of look at his network and figure out who else he brings in for due diligence. Then you kind of look at Twitter. VCs love Twitter and try to figure out sort of what their opinions are on different stuff. So it's like, this is one of their fundamental, it seems like a fundamental belief, constantly hiring. But I hope, so this is how you sort of build a mental picture of who an investor is. And you got to do this for whoever you're meeting with. So you might be meeting Seth, you might be meeting Ella. I'm not sure. It really depends on sort of how you find your way in. But I hope that gives you at least a little bit of an idea on how to do research into an investor. The other thing I forgot to mention, go onto this website called Crunchbase and look up 50 Years Fund. It'll give you a good idea of all the companies that they've invested in, what has worked, what hasn't worked, so on and so forth. Finally, you want to have what's called a term sheet ready. If you go on the IBZ wiki, we have a bunch of templates for you. You can raise on what's called a SAFE, simple agreement for future equity. You can raise on convertible debt, or you can do a straight equity round. All these templates exist. I won't go into the details of this later. You can read this book called Venture Deals by Brad Feld. It goes through the details of each of these subcategories of agreements you can use. At the early stage, it's easiest to use a SAFE. I'll just say that. I'm happy to go into reasoning at the end of the talk. That alone is like an hour topic, but I'll stop there for now on sort of what you need to have ready. Oh, sorry, the final thing. I created this mini tool, literally like an Excel sheet of which you'll be talking to hundreds of investors. Like when I was raising my seed round, I talked to 117 investors and I closed 9 of them, which means I was having dozens of conversations at one time. And I don't know about you, I'm super forgetful. So I had to write down at what stage I was in conversations with different people. So I created essentially like a relationship management tool, a simple one at that on Excel. I've put a link in here. You're more than happy to use it. Copy that template and use it for yourself. So yeah, what I had ready out of all this, I did not have my due diligence. So now that I told you what you should do, let me tell you what I didn't do and tell you why. So I didn't have due diligence materials ready. I didn't have a term sheet. Hell, I didn't build a CRM. I had half of a demo. I had a list of investors I want to go after, and my legal docs were ready. And this is why raising took me close to 12 months. Whereas most people, if you have everything ready, will take you 6 months. Because I learned this the hard way. I went out and pitched, and then investors were like, okay, send me your due diligence materials. And I'll kind of scramble over the weekend putting them together and then send it to them. And whereas I could have taken a more, let's call it, focused approach from the get-go. So yeah, that's just one example. There's examples, and then same thing is true for term sheet, and then same thing is true for building out a CRM. Okay. So actually, before I move on, any other questions? I know I threw a lot in there.
Harry, I'll throw one more in there. Would you mind elaborating a bit on, I guess, like a baseline of legal documents that you should have for your security?
Yeah. So your incorporation document, it's something you get from Corporations Canada. You should have your shareholders agreement with a good idea, and that should outline who's on the board, who controls the board, like what decisions the board is able to make. It's slightly different depending on which lawyer you work with. Generally speaking, it's called a shareholders agreement. Cap table, I mentioned that. And also that your cap table should also not just include who owns what equity, but also on what vesting schedule they're on. That's the baseline. You can throw in more stuff. For example, if you have contracts with a particular customer, you can throw that in there. If you special arrangements with particular investors in the past, presumably a lot of you don't have that, but down the road, if you're raising like a Series A round, you'll also throw in all the investors that have invested and on what terms, the safes for them and things like that. But you don't need to worry about that. For now, it's just those three things as a starting point. Before the pitch, what you want to have ready. So I've broken this down into sort of grunt work and research you got to do, and then what you should do to demonstrate higher value. So a big part of the battle is before you go into the meeting, what perception have you set with them? The good entrepreneurs will get an intro from someone who's part of their mafia or an investor entrepreneur. For you, it's easiest to get an introduction from an invested entrepreneur. So, as an example, we looked at 50 Years Fund, right? Go to one of the companies or one of the entrepreneurs that they've invested in, like try making friends with them. And especially if they're in the same space, you probably will have a lot to talk about. So if I was Daniel, I'm using Daniel as a guinea pig throughout the talk today, so I'm going to continue that trend. Reach out to one of their synthetic biology companies. Like, hey, I'm working in this parallel space. I'd love to learn more about your experience building your company and also raising capital. 9 out of 10 times the founder will say yes to taking a meeting with you, even if it's a cold reach out. Once you build enough repo, you can not only talk like where the industry is going and if you can add any value, but ask them for like genuine feedback and stuff you're struggling with. One of which you should bring up, like, hey, we're going to be raising our round in the coming weeks or coming months. I'd love it if you can make a few introductions for us along the way. This is the easiest. And then if you do this with 5, 10, 15, 20 entrepreneurs, you'll have easily a list of like 50 plus entrepreneurs right there that you can go after. This is what takes the longest is building your own network for fundraising. So for folks like Ashraf or Daniel, they've been part of the Lab to Market program. This is second nature to them. They're okay reaching out to strangers and talking to them. You're essentially using that same underlying methodology once again here. The other, albeit not as popular way, is putting together press releases. It's a lot of work and it's very hit or miss. I did this. It worked well for us, but for most people, press releases don't really work that well because there's just so much noise these days, especially there's so much noise, misinformation, everyone can create content. So press releases kind of get lost. Okay. So that's demonstration of higher value before the pitch. Then then obviously research the investor. And we kind of did a version of this. I'm going to skim over this stuff. Look at their values, look at their Medium post, Twitter, and also their professional network. At the firm level, who else have they invested in, what their investment thesis is, and more importantly, how you or your company fits into that thesis. Okay. Now the pitch. So the pitch these days, I mean, the world is opening back up, so you'll see this, but more and more pitches are virtual these days. You don't typically need to go to a place like SF or be in Toronto to meet investors. You can do a lot of this virtually, but it's a lot more casual than you would think. Essentially, you meet investors typically over some food or coffee for the initial pitch. If they buy into what you're doing, and now I'm thinking if you're VC, for an angel investor, they'll typically just make the decision over like a lunch or coffee with a few follow-ups. But if you're VC, then they'll bring into you what's called a partner meeting. This will typically have at least one of the investment partners there, sometimes multiple. And anyone who wants to they want to bring it for due diligence. One of the things, and I'll get into more detail about what they will ask you and what you should ask them during the pitch. But one of the key things you should keep in mind is all the people who are on the calendar invite, who's coming, make sure to research every single one of them and have a good idea of why they're there, what type of questions they'll be asking you. Once they have a chat with you, they'll typically bring you up to what's called a formal partners meeting. Typically happens on Mondays. So if you've raised multiple times, you'll realize almost no investor will take entrepreneur meetings on Mondays. It's because they're going through partner meetings of their own. So what happens at this partner meeting is whoever the lead partner who's met with you is going to present a case for your company to all the partners and why this should be a good investment opportunity for the firm. And typically at this point, they haven't made at this point, they'll make a decision on whether to conduct further due diligence with you or pass on you. Once they agree to sort of go into further due diligence, that's when they'll ask for, okay, share your data room. And then a bunch of people will sort of access that data room, go deeper, any one of the people that I mentioned in this sort of firm structure. Typically the due diligence team, partners, analysts, and associate, from time to time, the advisors. These four groups will kind of access your data room and go deeper into why they should invest in you. The fundamental thing, and I mentioned this before, is being able to tell a compelling story throughout this entire process. And when I say story, it's not just a story of your value proposition. It's also a story about you. It's a story about how you will impact the future. It's a story about why ideally you will become a monopoly company. Okay. And this story, as I mentioned before, is comprised of these primary three categories of risk: execution, market, and technology or product, depending on how you look at it. I went into the types of decks you should create. Thanks to Daniel. I'll sort of leave this here sort of what you should cover in each of these decks. Obviously, other due diligence materials you should put together, but these are the four things that will help you convey your story the best. Almost everything else is ancillary. The one exception being the investment memo that you will write. Again, this seldomly happens at the pre-seed stage, but it'll definitely happen seed stage and beyond. Excuse me. So I'll stop there and pause for questions once again. Before I move on to questions you will be asked and questions you should ask the investors. Okay, power on I shall. So you should have answers to all these questions. Investors at any point will ask you any of these 11 questions. I'm going to talk about a few important ones. Before I get into why they're asking these questions, or before I get into how to answer these questions, I want to talk about why they're asking each question. What investors say versus what they mean and what they're really after, two completely very different things. If you've interviewed anyone, you know that. How did you come up with the idea? They want to know that, but they're fundamentally looking for your motivation. Will you stick around through the tough times? Is this a problem you feel super strongly about? What do you understand about this market that others don't? By far, the most important question on this list. What is the hidden truth you understand or know that will help you win this market? You don't have more resources than the big companies that probably were working in the space. You probably don't have not just the resources, but the people, the backing. So you need something else to compensate for that to make sure you win. Number 6 is an important one, which is, why is this the right time to start this company? And it shouldn't be like, oh, I ended my PhD, so I thought this would be a good time to start a company. It has to be more esoteric than that. It has to be given. So when investors asked us this question, it's like, we were building a smart contact lens for glucose monitoring. So it combined like semiconductor technology, it combined contact lens technology, and it combined like novel sensor technology. Our answer was, this is the first time in human history where the semiconductor industry has reached the level of microsensors such that they can be integrated. And that's why what we're doing is possible just now. A few years down the road, this would be too late. A few years before us, it would not be possible. And that's what makes timing really, really important here. The other question that's really important is number 8. What keeps you up at night? And this is kind of, if you've ever been in an interview, it's kind of like, what's your biggest weakness? It's one of those types of questions. It has to be a real problem that you face, but you got to have a solution for it or a counter against it. The other question that's important is like, what's your valuation? Seriously speaking, you won't know. So basically what you want to say is something like, look, we're raising on a safe, we're talking to multiple investors, but given what we've seen other companies in the space raise, we're going for a cap of $5 million. And we're planning on raising a $1 million round. So you want to say something like that. And again, you'll find this data of similar companies and comparables on Crunchbase. Yeah, those are the most important questions. All these questions matter, but I'm just not going to spend the time to go through every single one. If you have more detailed questions, I'm happy to go through it. Okay, next. Most people forget that bringing on an investor is a two-way street. It's kind of like dating and then kind of getting married if they choose to invest in you. Which means you should ask questions of them as well. You shouldn't be the one just like offering everything up. It's a true partnership. As a matter of fact, one of my mentors at one point said, once somebody is on your cap table, aka somebody takes equity in your company, it's easier to get like divorced than it is to get somebody out of your cap table. That's how seriously you should take this. So, questions to ask them. Depending on who they are, it's like, how big is your fund? Or if they're an angel investor, how did you make your money? There's tons of people who are social investors. So they'll call themselves angel investors, but they'll write like 1 or 2 checks a year. Speaking of which, I've written only like 2 checks this year. So I'm a social investor. You don't want to be wasting your time with me. You want to be wasting time with people who are writing like a check a month. They're serious about what they do. What type of companies do you invest in? At what stage do you invest? Is really important, because this gives you a good idea of what they'll be looking for. And then you always want to follow up with why. The other thing that's really important is question number 7. What's your process for making a decision to invest? And this is where they'll tell you stuff about, okay, we're going to have a partners meeting and then we'll move into due diligence. Every firm is a little bit different. Generally speaking, we'll follow that structure, but some parts will be elongated. It's important for you to know which those parts are. Ultimately, you want to get a good idea of what data they will need in order to make a decision. And the most important thing from sort of figuring out if the investor is right for you is being okay hearing a no. A no is much better than a maybe. Investors love giving maybes because they can string you along, and they're typically the last money in. They have no incentive to say no. But that means you'll waste a shit ton of time just talking to them, and that's a bad idea. And like, that's not a good use of your time versus going out and chasing other investors. You should ask them sort of what are you going to be like once you invest? So are you going to change as a person after we get married, or after, we shake hands on the deal? And a good way of asking this, like, hey, how have you helped your entrepreneurs in the past? How hands-on are you? And this will give you a good idea of sort of how they like to operate, what they keep in mind, so on and so forth. This is important. Once you've given them, so once you've gone through due diligence, once they have all the data that they need, close them in 2 weeks. They'll try, as I mentioned, giving you maybe and elongate the process, but you should constantly be asking them, hey, what data do you need to make the decision? And if they can say, hey, I just need to think about it, then it's like, there's no universe in which they need more than 2 weeks. Investors will this is where investors get pushed around a lot of entrepreneurs. Don't let yourselves get pushed here. I'll quickly just go over the raising mechanisms. There's 3 main ones. I put a 4th one down, but it won't be like, most of you will not use a special purpose vehicle. You can Google it at your own time. So first and simplest is equity round. So this is the type of stuff you see on Dragon's Den. I'm here seeking an investment of $100,000 for 1% of my company. A convertible debt it's debt as the term implies, but it can be converted into shares down the road. And you don't have, the good thing about this is you don't have to set a valuation right now. Similar thing is true for SAFE, except a SAFE does not count as a debt instrument. It only converts into equity down the road, which is typically what you and the investor want anyways. As I mentioned before, I recommend you raise on a SAFE. It's the easiest. There are exceptions to this. Again, 80-20 rule apply. The one downside of doing a SAFE is whenever you're going to convert your SAFEs into actual equity positions, it's going to be a lot of work wrangling and getting investors on the same page and converting them to equity. But at the early stage, it helps you raise quickly, efficiently, and just you get into company building mode much faster. Okay, I'll stop there because that brings me to the end of the investor portion. I'll now go into grant portion next. So, but before I do that, I'll want to leave some room open for questions. So, raising money from government grants and pitch competitions. Presumably, some of you have already done this. So, I'm not going to go into too much detail because I feel like most of you will know about this, but I want to share some tricks and tips along the way. So, just as a background, I raised about $500,000 in grant money over the course of my company. Equity free money that I need to pay anybody back. It was a matter of just like putting together a bunch of paperwork. So my general piece of advice is the first 100K, maybe at the 50K too, but 50 to 100K, go raise on your own. This will create some base templates and a story that looks well to a grant reader. Once I did that, I hired an undergrad or grad student. There's tons of them out there that are jobless and will love the opportunity working at a startup like yours. Essentially get them to write. I got my undergrad, or he finished his undergrad. He'd just write a bunch of grant applications. And that was his primary job. He'd write applications. If we were selected to the next round, I'd go in and pitch and we'd get the money. So I think we paid him. He was, by the way, he wasn't even like, we didn't pay him salary. He volunteered with us and made us like 100K in the first 8 months of just working with him. And then obviously spend time. You as the founder of the company should spend time building your networks at different government agencies. So again, networking, storytelling will matter a lot here as well. Okay, so this is sort of my high level strategy. Won't work for everyone, but I think it will work for most of you, especially if you're in deep tech. It's a numbers game. For every 100 grants you apply to, you'll get 10. To get that 500K, our team probably applied to at least 300 grants, at least. And it can be that, by the way, that could be the same grant year after year, and we maybe just got it second year or third year. But yeah, there's a lot of grants out there. Some ways of searching, and we also have a funding portal. If you're not familiar, we post about grants that IBZ comes across right there, and it covers like 90% of Canadian grants. The other good place to look is Twitter. Just type in #grants. You'll see a shit ton of grants you can go apply to. So one of the things you'll be doing is pitching when you're applying to these grants. And the way I think about pitches is the following. There's usually some backbone to your plan, to your pitch, which is what I call the plan. This can be the business model canvas. You might have been crazy enough to go write an actual business plan, whatever, right? And you essentially want to carve this into 3 pitches that you should always have ready. An elevator pitch, which is no more than 1.5 minutes, a 5-minute stage pitch. A lot of pitch competitions will ask for this. And then a 10 to 15-minute presentation that typically happens behind closed doors. Just quickly talk about what's included in each one. In the elevator pitch, problem, solution, what makes you special. And then this is typically you meet somebody at a conference or like an intro whenever you're talking about your company, when you're having a first meeting with somebody. It's like, how can we work together? Okay. Then you go into standard pitch. This is typically, like I said, 3 to 5 minutes. You want to include some combination of these 8. You want to start with an umph and end with an umph. The bare bones is problem, solution, market, traction, team. Business model is, I teeter with it, but at minimum, you should try including it if you can. A long pitch will have the following things. It will have basically all these things. The key thing to focus on in long form pitches is traction. What have you accomplished? And why is this a good opportunity? Again, the key part here is being able to tell a compelling story. So the storytelling strategy is going to come in handy both in raising public funds as well as private funds. I'll skim over the sales revenue is sort of the last portion. I'm not going to go through it. I didn't want to make this presentation about sales. I wanted to make it about raising capital. So I'm just going to skip through this section. I kind of want to talk about a few minutes about what makes a compelling story, because this is a backbone you're going to need whether you're doing sales, whether you're talking to investors, or whether you're pitching to a government, to an incubator or such. So you want to have a hook. You want some way to lure them in. Why should I care about this? Whatever this person is talking about. It could be for personal reasons that they have to take a meeting with you. It could be for the sake of the problem. The second thing, and I absolutely hate people who don't do this, there is there's bad liars, there's bad entrepreneurs, there's people like Elizabeth Holmes, 100 feet of dirt, and then there's people who have no point to their stories. That's how badly I think of people who don't convey their message concisely. Having a point, people who ramble on will almost always lose credibility right on the spot. So everything needs to lead to some accumulating event that matters to the listener. You want to choose the right time to tell the story. This is especially true for conferences, or if they're in a rush. This is where your EQ is going to kick in. You want to be mindful of what they want to hear, why they want to hear it, and what they're looking for. And this is why you want to have different ways of saying the same story, because it will appeal to different people. This is counterintuitive to a lot of engineers, using vivid details and not regurgitating facts. I'll give a quick example of this. So an investor, a common question that an investor asks me, like, who's on your team? What does everyone do? And the facts version of the answer, at least how I used to answer before, was, oh, my team is made up of me. I've worked at the intersection of healthcare and technology. I've worked in the diabetes space. My co-founder has worked at Harvard Medical School, has done all this amazing nanotechnology research, and that gives us the advantage to go tackle this super complex challenge. Yeah, that's a good answer. What's better is summing all that up in one line. Look, our team is comprised of people with background in technology, healthcare, nanotechnology. We're really, really well-rounded. But what's more important is the grit that we put in. So when we're starting the company, my partner, Huai, was a student at University of Toronto. He would drive in every single weekend. We'd work on this over the weekend. He'd sleep in my sleeping bag. That's how this company got started. Until we both decided to drop out of school and go build this company and raise the capital that we did. So it's like a vivid detail about the value. It's showing rather than telling. Facts tell, details show. And that's the fundamental difference. Make sure it passes the grandma test. Investors have massive egos. They don't want to look stupid in front of you. So make sure you are able to distill the information down into something really, really simple that they can understand. And then have multiple smaller stories that make up the bigger story. So the bigger story, to go off of my team example, the smaller story is like, this team is awesome. They put in incredible hard work. The bigger story is the story that they're telling us of why this team will win this market and build a monopoly. And the smaller story sort of contributes to this bigger story. So you want to create that mental map for the investor. You're essentially creating a framework of what the other person thinks of you based on the stories you tell them. it's mind sorcery, for lack of a better word, you're trying to accomplish here. And then finally, follow the golden circle. I'm already at the hour and a half mark, so I won't show you the video. But yeah, you guys know about the story arc. Every story that you say, there has to be a crisis. Oh, we couldn't work on this unless we came and worked on this on the weekend. And once we started working on the weekend, that's when we made progress, and eventually we got to building our company. Oh, this one time, all of our dev team quit on us within like one week. We had to go find, 2 developers overnight. So what we did was we reached out to our friend group, and in under 2 hours we had 100 applicants. We ended up selecting one of them, and we're super happy with the progress that he or she has made. This common arc should follow all the stories that you tell. Golden circle, simply put, again, you can watch this on YouTube or wherever, but instead of starting at the what and moving your way in, you want to start out why it matters and then go to the how. This doesn't need to be true for every single damn thing you do, but whoever your audience is, they need to have a good idea of why you're saying the things that you are, and that you give them a schema, aka a way to think about the information you're giving them. So create the framework in their mind of how to think of you, rather than them creating that and fitting you in. Okay, I won't go into this video. I'm just going to skip it. So I started this presentation with, there's 3 ways of bringing money to your company: private investors, government funding, grant funding, and sales revenue. You'll constantly be at battle, and it's super fucking common to figure out which one of these you do. And that's up to you to figure out. So I'll stop there and leave the last few minutes for questions. I put some case book recommendations. I always like to end on something like this that will help you understand this, whatever I've discussed, in a lot more detail. But yeah, that's kind of all I have for now. Yeah, any questions?